Hey guys, Tom here from the Investing with Tom YouTube channel. Welcome back to the channel. If you enjoyed today's video, hit like, hit subscribe, and that way you can see future videos as well. So one of my favorite investors, Guy Spier, recently sat down and did an interview with a fellow YouTuber, Kiana Invest Diva. Now I'll leave the full link to that full interview down in the description below. But as many of you probably know, anytime one of my favorite investors does one of these interviews or does a talk, I kind of like to just watch them basically as soon as possible and see if I can learn anything from it. So the topic for this discussion, the sort of overarching idea was, is value investing dead? And now, spoiler alert, Guy Spier, a value investor of well over a couple of decades at this point, obviously does not think it is, and neither do I. But nonetheless, there were some really good lessons in this talk that Guy Spier did in this interview. So I want to share my top sort of 4 or 5 lessons from that interview in this video. So with all that said, let's get straight into it. Now, the interview basically starts out by Guy Spier being asked, is value investing dead? You know, we're seeing all these high-flying growth stocks do really well. We're seeing things like Bitcoin do really well recently. And a lot of the sort of traditional, I guess, value stocks or traditional value investors are kind of getting laughed at the moment in a lot of ways. And Guy Spier basically sort of laughed back at the question and said, there's no way that value investing is dead or that intelligent investing is dead. So this is the way that he sort of described it. He went all the way back to the idea of what you should be doing with an intelligent investment in the first place. And basically what Guy Spier explained is that you should think of buying a stock or buying ownership in a business just like you might buying a piece of real estate or buying a farm. Now, when you do some sort of analysis on a farm, maybe you're looking at how productive that particular farm is going to be and what kind of profits it can generate. You know, Guy Spier gave the example of looking at a farm, trying to figure out what crops it can grow, how much you'll typically get paid for those crops. And the long story short is basically you can arrive at a very rational price to pay for that farm, given the return you want to make and what you can expect the cash flows to be generated from that farm to kind of be. So that's what Guy Spier said. And that investing strategy over a long period of time just works. There's no denying the maths of how that strategy just works well over time. But he mentioned that, markets are cyclical. We will go through long periods of time where people that employ a strategy like that will look more and more foolish, will look like complete idiots, and will lag the people that are potentially taking far more risk and far less intelligent investing strategies and doing really, really well. So the whole thing's cyclical. For periods of time, value investors are going to look really stupid. For periods of time, your neighbor that knows absolutely nothing about investing is going to look really, really intelligent because they're making money in all these speculative stocks and other assets. But over a long period of time, value investing is very, very hard to beat. And it was really interesting that Guy Spier was actually doing this interview on the same day that Elon Musk put $1.5 billion into Bitcoin. Through Tesla, it shot the Bitcoin price up even more in recent days, and it was a massive news story. And basically, Guy Spier explained that, those assets have passed him by. And it's not just Bitcoin or cryptocurrency in general. It's many of the high-flying growth stocks. He missed Amazon, for example, and he's missed many, countless other stocks that have done extremely well. But he doesn't concern himself with missing things like Bitcoin, for example, because he's focused on buying productive assets at reasonable prices. Now, he can get potentially peeved at himself by missing things like Amazon. But again, if we go back several years, it was not obvious that a business like Amazon was going to succeed massively out into the future. So you can't beat yourself up over those things. There are periods of time where the strategy is going to look very foolish compared to, higher growth, higher risk type strategies. But over the long term, like Guy Spier has said repeatedly through this interview, value investing is quite hard to beat. Now, the next thing that Guy Spier spent a fair bit of time talking about was one of his portfolio companies that is very close to his heart, and that is a business called Nestle. Now, this isn't a company we typically see on Guy Spier's 13F. That's because it's a company that's not listed in the US. 13Fs only show companies that Guy Spier holds in the US. That said, over half of Nestle's business is actually done in the United States, and it's a pretty well-known brand all around the world. And Guy Spier thinks of Nestle as a business that is a true compounder, something that's going to grow its intrinsic value substantially over a long period of time. And the way that Guy Spier thinks about that position in his portfolio is that he's identified a great asset, he's bought it at a reasonable price, and his primary role now is to do absolutely nothing with that holding, is to treat it like the compounder it is, not get too caught up in necessarily what the market price is doing, not get caught up in year-to-year results, just focus on the fact that in 10 or 20 or 50 years, a business like Nestle is going to be much larger and much more valuable than it is today. And that takes a lot of the sort of mental pressure I sort of gathered off of Guy Spier. It's a type of business that he can hold through pretty much any market cycle, and that's the way that he really likes to set up sort of the core of his portfolio. And that actually brought Guy Spier to kind of another bit of psychology when it comes to investing that he really likes to plant in his head, particularly before he makes a decision on an investment, whether it's to buy it or whether it's to take a pass on it and move on to sort of the next idea. And basically that idea that he plants in his head, or the kind of situation that he puts himself in, is he says that anytime he goes to make one of these investing decisions, he pretends that God is watching him. And he knows that anytime that's happening, when he's about to make an investment, if he buys into that company, it's almost guaranteed to go down, let's say 50%. And if he passes on that company, it's almost guaranteed to go up 50%. Now, that obviously doesn't actually happen in real life, but that's the mindset that Guy Spier kind of puts himself in. And he makes sure that he's mentally prepared for the fact that if he buys into a new business and it goes down 50%, he's going to be perfectly fine coping with that, and he's potentially going to see it as even an opportunity to buy an even larger stake in a really good business. And if he passes on a company and it goes up 50%, he's got himself in a mindset where, you know, that business fit wasn't right for him, or he thought it was already overvalued, and it's not something that really keeps him up at night or that he views as a mistake. Now, the next thing that Guy Spier talked about was a little bit more of kind of like a technical aspect of managing a portfolio around rebalancing. Now, if you don't know what rebalancing a portfolio is, it's basically the concept of having, some stocks in your portfolio are going to go up during a certain period of time. It's basically selling off a portion of those stocks and putting them into other ideas that have maybe gone down or not performed as well, and having sort of an even distribution throughout those different investment ideas, or at least having them sort of allocated at kind of target percentages in your portfolio. Now, Guy Spier basically said that is something that he does not do, and he mentioned an example of Ferrari in this interview. Now, Ferrari is a business that he has held the shares of kind of as their own entity for about 7 or 8 years now. Ferrari was initially spun out of Fiat Chrysler, which again is another investment that both Mohnish Pabrai and Guy Spier were involved in and have been involved in for several years, particularly Guy Spier. Pabrai is out of it now. But Ferrari has now become a huge part of Guy Spier's portfolio, and it was never anywhere close to that percentage of his portfolio at cost. You know, he didn't put a huge percentage of his portfolio into just Ferrari specifically when he first bought it as part of kind of Fiat Chrysler, but now it's been spun out and it's grown into a substantial percentage of his portfolio, and he's comfortable letting those things run. And I think that idea has been locked into his head from a couple of different experiences. One that he talks about in this interview is his experience with McDonald's. Now, McDonald's is a business that he captured about a 3x return on. If he'd continued to hold McDonald's, it would now be approximately a 20x. Now, by my calculations, kind of going back through the stock price history and so on, that tells me that Guy Spier probably was invested in McDonald's in the early 2000s. But nonetheless, he sold McDonald's and he missed out, on an even bigger home run than he already had. Now, another example for Guy Spier is Crystal. This isn't actually a company that he talked about in this interview, but I know for a fact that if Guy Spier continued to hold on to Crystal, that holding alone would now be larger than his overall portfolio that he's got today. So I think that message has kind of been seared into Guy Spier's brain that if he can get these good companies that are high quality compounders and hold them over a long period of time, he shouldn't go about rebalancing and trying to, cut the flowers and water the weeds, as I talked about in a previous video from Peter Lynch. Now, the final point I want to touch on from this interview from Guy Spier is sort of twofold. Now, the first thing is that when Guy Spier buys ownership in a business, buys a shareholding in a business, he really does think of himself as an owner. And he gives this example again of when he was a shareholder in McDonald's, sort of in the early 2000s. And he really liked being a shareholder in that particular business because it was the type of company where the products he could go out, he could see, touch, and feel the products of McDonald's. Unlike having a shareholding in maybe some sort of biotech startup or even some sort of software company, McDonald's is a business where he could literally go to the restaurant and see how they're getting on. You know, he talks through McDonald's stock price going down over a period of time when it was in his portfolio, and he was sort of starting to worry that maybe no one's going to McDonald's anymore, and he was kind of concerned about what's going on. So he'd go to McDonald's fairly frequently, probably more frequently than he should have for the health of his waistline, as he kind of put it. But nonetheless, he could go to McDonald's and see that people were still buying the product, their restaurants were as full as ever, and it gave him sort of enough confidence to continue to hold on to that business. So that's sort of a psychological trick that I think really works well for someone like Guy Spier. I've actually used that myself. I used to be a shareholder in Domino's Pizza Enterprises on the ASX, and that's something that I did as well. The stock price was down slightly. I'd go to Domino's, order a pizza, and see that it's as busy as ever on, you know, a winter's evening. That kind of gave me the conviction at that time to continue holding on to those shares. Now, of course, if you go to one restaurant in one city, that's probably not particularly representative of the entire company around the whole world, but nonetheless, it's a nice kind of mental hack to get you in the right frame of mind. And the other thing that Guy Spier talks about as being a huge advantage when you see yourself as an owner of a business is that it allows you to stay in your own lane. You know, he talks about Warren Buffett, who's been compounding his wealth for a huge period of time at this point, and he's been through many periods within that multi-decade journey where he's had several people fly past him all of a sudden. You know, he's steadily compounding over a period of time, and you have people like, say, Elon Musk, for example, just recently absolutely power past him. And he's had, several maybe do it in the dot-com boom of the early 2000s, late 90s. And it kind of happens all the time. And treating yourself as a business owner allows you to kind of ignore that stuff and just stay in your own lane and stay on your own kind of compounding journey. You know, Guy Spier can continue to be an owner of Nestle and know that in 10, 20, 30 years, Nestle is highly likely to be a much larger and more profitable and more valuable company than it is today. So, you know, he spends his time thinking about Nestle, going down the shops and talking to the people stacking the shelves with Nestle products, and he really doesn't concern himself with people that may just be flying past him in very short spaces of time, because that's not his strategy. He's not looking for something that can propel him forward hugely in the short term. He is trying to be what Warren Buffett would call long-term greedy. It's a much better form of greed than trying to do something short-term greedy, and being long-term greedy just turns out to be a much more effective, a much more reliable way of generating a huge amount of wealth over the long term. You may miss some things in the short term, and you may miss some big things in the short term that turn out to do really well in the long term also, but the more that you can stay in your lane, focus on things that you understand and that you know for a fact, or as close to a fact as you can possibly get, that are going to work well over a long period of time, the more you can stick to those things, the better off you are going to be. So there are some of my big takeaways from the latest Guy Spier interview. If you did enjoy it, please hit like and hit subscribe. Again, the link to the full interview will be down in the description below. But that's it from me today, and I will see you in the next one. Cheers.